For your safe investments, for your safe dollars, what's better, a CD or a treasury bond? I'll explain the difference. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button for your safe dollars. Hopefully you're a long-term investor, and maybe as you're approaching retirement or early in retirement, you're working with your CFP on building out what we call a personal pension plan, basically stratifying your investments based on when you think you're going to need the money. And for your short-term dollars, or maybe even some of your intermediate term, what's better, a CD or an actual treasury investment, a treasury bond? Or maybe you've got some cash reserves that you're holding in your savings account or in a money market, and you've been looking, saying, well, how can I lock this interest, these high interest rates up for a little bit longer? Should I be using a CD or a treasury? I've had this conversation more in the past 15 months than I have in the past 15 years. Why? Well, part of it's because the market and the economy has been jittery, right? We've been spooked by this whole recession thing, not we as in us financial advisors, but consumers at large have been told there's 100% certainty, 100% chance we're going to see a recession. Never happened. And so with the Fed raising interest rates to try and slow the economy down, it's created this issue where you can get really competitive or high interest rates for the short term, and yet it increases the odds of some riskiness on Wall Street or a recession. And therefore, it's prudent to say, well, for some of my short-term dollars or some of my dollars that are intended to be safe and be a diversifier in my portfolio, should I hold some CDs? They're offering pretty good interest rates. Should I hold treasuries? What's the difference? Well, first, what's a treasury? What's a treasury bond? What's a treasury bill? Well, this is I don't know if you've noticed, but our government borrows a lot of money. It borrows a lot of money. And so where do they borrow the money from? Well, they issue bonds. They issue bonds that hopefully others will want to invest in. And when they invest, when others invest, that's them lending money. You buy a bond, which is you lending money to the government. Now, I'm not going to get into all of that. It used to be a lot of foreign countries that were lending us money, buying our bonds. That has shifted, and it's now mostly ourselves that are doing it. That's interesting. But treasuries come in a few different maturity lengths. So T-bills tend to be a year or less, and those could be as short as 4 weeks or 8 weeks or 17 weeks, 26 weeks, and then 52 weeks. Those are T-bills. Treasury notes, treasury bonds, those are longer. You can have a treasury bond that's 30 years. 20 years, so 10 years, so those sorts of things. And one of the interesting things that we've seen recently is, as the Federal Reserve, they control short-term interest rates. As they have increased short-term interest rates, you can get a really high short-term interest rate. A 13-week T-bill could be paying close to 5%, but if you tried to get a longer term, a 10-year T-bill or treasury bond or 20-year treasury bond, it's only paying 4%. It's paying less, which is counterintuitive. That is not how the economy is supposed to function. That's an inverted yield curve. Because this is debt issued by these are bonds issued by the government, you could say that it's extremely safe, it's risk-free. Some economists would say that because it's backed by the full crediting and issuing power of our United States government. And therefore, you don't have to worry about FDIC or those sorts of things. This is actually funded and underwritten by the government. Does that mean it is risk-free? No, it does not mean that, but these are considered generally extremely safe because their issuer is the U.S. government, who can actually print its own money. So that's the main advantage, that it's just about as safe of an investment as you can get. The disadvantage is it is a bond, meaning that you're going to invest in it, you're going to get a certain interest coupon payment, typically every 6 months or so, unless it's a T-bill. Those are issued at a discount, and then they redeem at the higher amount. So you're going to get that certain amount and then get all your principal back at maturity. But along the way, the value of this investment, it trades every single day. Therefore, the value could change a little bit. If you bought a treasury bond that was paying 3%, and now new treasury bonds are at 4%, then the one that you bought, if you tried to sell it, it's going to be worth a little bit less than what it would mature at maturity. So know that the value will fluctuate a little bit. And then lastly, got to understand how taxes work for treasury bonds. The interest is taxable on your federal return. But if you live in a state that you have state taxes, it's exempt from state taxes. That also is counterintuitive. You'd think, well, this is a federally issued investment. It should be tax exempt federally, and the states can tax it because, it's up to them. But it's the opposite. Federally, it's taxed. States, it's tax exempt. That's treasury securities. All right, what about CDs? Well, you're familiar with CDs. These are also issued in a variety of different terms and lengths, as short as 1 month, typically 1 year, 2 year. The maximum, I think, is somewhere around 10 years, but you don't see that often. Usually, 1 year or, a few months to 2 years, 3 years, maybe 4. These are issued, instead of being issued by the government, they're issued by banks, and therefore they're as strong as that bank is. Well, sometimes banks falter and fail. We've had a history of that. And therefore, the government steps in and insures up to $250,000 of CDs with a particular ownership at a particular bank. That's FDIC insurance. So you're going to want to understand those rules if you're investing more than that into treasuries or CDs. The interest on CDs, that is taxable as ordinary income, both on federal and on state. So there's actually more tax on CDs than treasuries. So I would say that's the con. What's the pro that CDs have over treasuries? Well, if you're buying it from the issuing bank directly, then you're not going to see any fluctuation in value. If you put 50 grand in a CD at your local bank, then every time you get your statement, it's going to say 50 grand versus your treasury, that the value could fluctuate a little bit. If you invest in a brokerage CD, so wherever you hold your investment accounts, if you buy a CD there, you will see that value of your CD fluctuate, go up and down, just like you will a treasury. All right, so that's probably more than what you wanted to know, but a compare and contrast of a treasury versus a CD. I know what you're asking. Well, which one pays higher interest and which one's better? Well, the interest that they pay can be pretty similar. These are both considered extremely safe investments, and therefore they're going to pay a very similar interest rate. Here's the unique thing. If you were to get a CD right now, the short-term interest rate's probably going to be, and I have no idea when you're watching this, recording it middle of February, probably going to get a 1-year CD around 4 to 5%. And if you find a local bank that's offering a CD special, maybe you're getting 5, 5.25, something like that. With treasuries, you're not going to get a special interest rate or anything like that. It's going to be based on what the Federal Reserve is setting and how they're influencing rates and how things are trading. And so you're going to get around 4.5 or between 4 and 5%, depending on when you're watching this. So you might be able to find a short-term CD interest rate that's a little bit higher than the Treasury security. However, be aware of those tax differences, those tax consequences. But in the short term, it's going to be very similar. So you'll want to see, well, how much am I investing? Am I going to be investing more than the FDIC limits? Therefore, maybe I either need to get more complicated and have multiple CDs, or maybe I should just go treasuries. Can I find a really good CD special at my local bank, something like that? But that's short term. If you've got dollars that you are using where I'm just going to be living off of the interest, I've saved up enough in my portfolio that I'm really just living off of the interest, I'm not creating a bond ladder, a CD ladder, something like that, then it's possible that looking at a treasury investment would be more appropriate right now, because you can actually lock in, even though short-term rates are higher than long-term rates, though the economy is distorted right now, you can lock in 10-year, 20-year, sometimes 30-year treasuries at over 4%, And while you might say, well, yeah, but I can get a short-term interest rate higher than that. Yeah, but at some point, those short-term interest rates are going to be coming back down to 3%, 2%, something like that. And maybe for your overall financial situation, it makes sense for you to take a chunk of, if these are intended to be long-term interest-bearing investments that you're going to just live off the interest, maybe lock in a higher interest rate. You'd be able to do that better with a treasury investment versus a CD. And then to thread the needle, where this makes the most sense is not for the average saver, and it's not for the average accumulator, someone in the middle of their career. Oftentimes, when you're looking at this connection between, or comparison between CDs or treasuries, it's right on the cusp of retirement or early in retirement. And if you're in that situation where you've saved up enough and you're just going to be living off of the interest, then work with your CFP, consider maybe a portion of your bond investments should be in some of these longer terms. Maybe you lock in some of these really good interest rates with some treasuries. But for the majority of folks on the cusp of retirement or in retirement, you need to look at your overall portfolio and pivot it into, when I retire and I start drawing off of this money, how much money will I be drawing out in the short term? That should be really safe. How much money will I be drawing out in the middle, in kind of the intermediate term? That should be more average. And using that buckets of money approach or personal pension plan approach, maybe building out a CD and treasury ladder so that you've got competitive interest being paid, stratified out over the first chunk of retirement, where you've got dollars maturing each year to help you fund or supplement your Social Security and fund your lifestyle. So which one's better? Depends on your situation, depends on the goals you're trying to accomplish and what you're looking to do. So work with your certified financial planner on that. They can help you take a look at your entire investment approach as it relates to safe dollars, but also as it relates to retiring and how to stratify your investments there. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.